The idea that he could put 8,132 tons of US Treasury gold into this new sovereign wealth fund for whatever purpose, I mean, I don't know where he's coming from on this, is a complete nonsense because it's not there. I mean, I assume some of it's there, where between 10,000 and 16,000 tons of central bank gold has gone missing. It's been leased and not returned. So who is the main lessor, if you like, of this? I'm pretty sure it is the Treasury Department, central bank, whatever, which was suppressing gold, trying to get gold out of the system and trying to convince us all that gold is a dead duck. The new currency, the new money is the dollar.
Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pinned comment. Stay ahead of the curve. Don't miss out.
Situation. And I've listened to all the commentary, and yesterday I listened to a conversation between various members, sort of researchers and analysts and so on, of LBMA firms, and they were saying, well, there's plenty of gold. I mean, they were just sort of glossing over the thing, really. But really? Nobody mentioned one thing which I've been monitoring, and that is the stands to delivery. Basically, what a stand to delivery is basically where the credit market meets the road of reality, if you like. But because Comex is run by banks, in effect, who deal in credit, not in physical, they basically, when you stand for delivery, you're not actually getting delivery. What you're getting is a commitment from the counterparty, if you like, on the transaction to deliver you gold at some stage. Now, what they do is they delay the delivery. I mean, there was a fascinating article by a guy who used to work for Sprott, and he wrote about trying to get delivery of silver out of Comex. And basically, he said that a 5-day settlement took 9 months.
Wow.
9 months. and that was with Sprott badgering as hard as they could, trying to find out this, where is it, the whole thing. Eventually, it was delivered in 9 months. Now, the reason this is important is because stands to delivery have been increasing quite substantially. I mean, if you look at last year, just looking at gold, I took out the figures. The stands for delivery last year were 491.2 tons. Now, basically, this year, that has accelerated. So far this year, 285.3 tons have been stood for delivery.
In today's news recap, JP Morgan says central bank buying will drive gold to all-time highs. JP Morgan strategists expect gold prices to move towards $3,000 per ounce in 2025. JP Morgan strategists say there are multiple macro scenarios that will likely push gold prices higher in 2025. But after a 30% rally in 2024, some investors are skeptical about where demand will come from with prices at all-time highs. The key will be from central bank buying and gold exchange traded funds inflows, according to JP Morgan's head of base and precious metal strategy, Gregory Shearer. Central banks aren't done with gold yet, with added political uncertainty likely helping to stoke a revival into 2025, he said in a recent note. According to data from the World Gold Council, after dropping in the third quarter of 2024, central bank gold purchases accelerated towards the end of the year, adding 333 tons, 54% higher than the prior year. The People's Bank of China, PBOC, also returned to gold purchases in November for the first time since April earlier that year. Shearer said, With the PBOC buying again and the potential for China's currency to be further devalued with the risk of tariffs, we think gold owning appetite among Chinese consumers could receive a boost too, as investors turn to gold as a real asset store of value. JP Morgan strategists say there are two potential macro scenarios that will likely both be positive for gold prices, but for different reasons. Under a disruptive path scenario, increased tariffs, trade tensions, stronger inflation, budget deficit expansion, and increased economic growth risks will fuel gold buying as a debasement hedge. In this scenario, central bank gold purchases will likely remain robust as markets experience higher yields, a stronger U.S. dollar, and higher gold prices. Whereas under a Fed-focused path scenario, even if trade tensions are contained and inflation remains under control, JP Morgan said the focus will shift to the Fed's easing cycle. This scenario also skews bullish gold in a much more traditional way, given gold's characteristic bullish skew versus falling real yields over a Fed cutting cycle, the note said. In either case, both scenarios will all help push gold prices towards JP Morgan's forecast of $2,950 per ounce by the fourth quarter of 2025.
Continues over the rest of this year. What we're looking at is over 2,160 tons being stood for delivery in this year. So the pace of the stands for delivery has increased. Now, even though the bullion banks use every trick in the book not to let you have your gold, if you look at it from their point of view, they have a problem. They can see that pressure is going to mount on them to deliver. Therefore, they've got to have the stock. And that's basically, I think, what has led to it. We can feed in another thing into this, and that is that anyone who looks at the chart of gold would come to the conclusion that it's going higher. Now, that includes bullion bank traders. I mean, you know, they're not idiots.
No.
So they're in a position where they are short on Comex. Now, we don't know what their position is in London because, I mean, traditionally, the idea was you'd be long in London and you cover in Comex. I don't actually buy that story. I think it's a lot more complex than that. But if we look at Comex, you can see that the short position is getting increasingly painful.
Mm.
And if you add into that the fact that you've got all these stands for delivery, and I can tell you that the stands for delivery from 21, 22, 23, and 24, almost 2,000 tons. Now, some of that presumably has been delivered, but you can see the pressure that's coming on the establishment, if I can call it that, in Comex. This is why Comex has had a sort of bear squeeze, because at the same time, if you look at outstanding contracts on Comex, recently they've fallen by 75,000 contracts. That's the open interest. Now, while it's been falling by 75,000 contracts, the price has been rising. So what's that? It's a bear squeeze, and it's a bear squeeze on the shorts. It's as simple as that. So that is basically where the problem is. Now, look at it from the point of view of the buyers. We don't know who they are, but it's reasonable to suggest that the people standing for delivery aren't that close to Comex, if you like, as an institution. They're probably dealing via Globex, which is the global dealings which occur, when New York's shut and all the rest of it. So, if, let us say, you are the sovereign wealth fund, central banks, a very rich Asian family, and you stood for delivery, you're now looking at this new world with President Trump. And there are two things here which will worry you. The first is that Scott Bessent is keen to set up a sovereign wealth fund, of which the Treasury's gold will be a central part. Now, what Scott Bessent didn't know, but presumably he's now been put straight, so we'll probably go quiet on this one, is that most of the gold just ain't there.